So, morning and welcome to our latest Profit Expert Live event. And today's session is called the Tax Year Reset. And late March is a great time to do this because you can almost feel the new tax year coming. It's close enough to focus the mind, but there's still time to do something sensible before the 5th of April. And just importantly, to start the new tax year properly. Now, this is not going to be one of those sessions where I throw a load of tax rates and thresholds at you. We'll do that separately. We'll send our tax card round in a couple of weeks. But what I don't want to do is do that on today, is batter you into submission with tax rates and have everyone switch off after about 7 minutes. The point of today is much simpler than that. It's about helping you put a proper plan in place. So a plan of how you take money out of the business, a plan of how you claim of what you're entitled to, and a plan about how to think about the bigger decisions that affect tax, affect cash flow, and will affect your stress over the next 12 months. Because for most owner-managed businesses, real pain is not usually a lack of clever tax ideas. It's messy habits, it's reactive decisions, and it's leaving things too late. And it's that feeling of, we'll sort it later. So today is about replacing guesswork with a plan. So who is this for? As always with our Profit Expert events, it's really aimed at owner-managed businesses that are already doing kind of reasonably well. So doing strong 6 figures, aiming for 7 figures, absolutely relevant for you. And like I say, if you're not there yet, but you're ambitious and that's where you want to be, get to 7 figures in the next few years, great. It's kind of spot on for you too. Because what we find is what happens as businesses grow is this. At the very start, tax can also be a little bit of an afterthought, particularly in because it's paid after the end of the year, the corporation tax in year one. It's quite a while to actually have to pay any. But then as the business gets bigger, the numbers get bigger, the decisions get bigger, and the consequences of getting it wrong get bigger too. So suddenly what used to feel manageable starts to feel a bit scrappy. You might have more turnover, but you've also got more stress. You might have more profit, but there's also more pressure. And you might have a business that looks very successful from the outside, but you still feel like bits of the financial side are being made up as you go along. And that's kind of exactly where this session sits. It's for business owners who want more clarity. They want fewer tax surprises, better cash flow, and a calmer way of making financial decisions. And as always with these Profit Expert events, we want this to be practical, like not just fluffy. So at the end of the day, I want to leave with 4 things. Firstly, a framework for how to think about your direct pay plan. Secondly, a simple owner manager checklist will give you something you can kind of download that summarizes this. Third, a sense of what you should be tracking monthly, so you have fewer surprises. And fourth, 5 good questions to ask your accountant, because good questions lead to good answers. So we want you to know the questions to be asking to get the good answers from your accountant. And it may be, and that accountant might be me for some of you as well. And it's always worth being aware with that is actually, for some people, your accountant will be doing this already. For some, they won't. But also actually to be aware of actually what service you are actually paying for from your accountant. And we had one yesterday where we did a quote for somebody and they said it was significantly more expensive than another quote, but it wasn't comparing apples with apples because our quote was including some additional tax support and advice, and the other one wasn't. So yeah, you do have to take that into account, but we'll give you some questions to ask, because certainly my aim is not to leave here thinking that was interesting. I hope you do leave here thinking that was interesting, but more importantly, you leave here thinking, right, here are 2 or 3 things that we need to tighten up, 2 or 3 things we can do, 2 or 3 things, actually to plan for next year. That'd be a much better outcome of the session. And that's always true with these Profit Expert web events we're doing. So let's look at the framework. So everything today broadly fits into 3 buckets. Number 1 is building your direct pay plan. Number 2 is building a clean system to claim your tax expenses and relief. And number 3 is planning your big moves early. And in some ways, that's it. That's the session. So if you ask someone gets bored in 7 minutes, we're done. You can go now and just take that away. But if you get those three things right, a lot of other problems become smaller. You reduce the tax surprises, you improve your cash flow, you make better decisions, and you stop doing that classic thing that many of us do as owner managers of businesses, which is treating March as a mad panic, but then April as a clean slate. The idea is tax planning shouldn't be a once a year scramble. It should be part of a rhythm of running a decent business. So on the next page, we've called it poll. We're not going to do a Zoom poll actually on here right now, but it's a quick question, I suppose, to actually think and answer yourself of what's the thing that bites you most at the moment? Is it getting a tax surprise over how much the tax is? Is it missing claims, or is it stress over paperwork? And usually what happens is you get a bit of all three, because they'll feed each other. They all interlink very much, because if your records are messy, you miss things you can claim. If you miss claiming things, you overpay tax or get caught out with the tax bill. And if you get caught out, the stress goes up. So what we're trying to do today is break that cycle. Now, the next slide, for those of you who get my weekly email accelerator, 10:30 every Thursday, excellent. You might recognise this title from last week's. For those who read it, you might recognise some of what I'm going to say as well. But basically, the point I want to make is why salary versus dividends is old news. For years, the standard kind of owner manager conversation was basically how much salary should have taken, how much dividends, and the answer was very often to take the tax efficient small director's salary of, say, the personal allowance, either tax free personal allowance of £12,500, and take the rest of dividends, because the company gets tax relief on that £12,500. You receive it tax-free, and then beyond that, dividends were more tax efficient than taking a salary. And fair enough, that worked. And the question about salary versus dividends kind of matters. It still does matter. But the reason I keep saying it's old news is because the gap is nowhere near what it used to be. The numbers I've got up here are an example of a limited company with £250,000 of profit, taking £100,000 out. And the figures do take into account, so for example, in the first column of taking out as a salary is basically the company spending £100,000. So that means, because it includes employers' NI, that leads to a gross salary of about £88,000, and then PAYE comes off that, national insurance, and therefore what it leaves the director. So if back pre-COVID, if the company was to use £100,000 to reward the director, after paying those taxes, employers' NI, PAYE NI, but after claiming corporation tax relief on the salary, the net tax impact would be, it would cost £40,000 across both limited company and the director. So basically left the director in round terms with £60,000, 60,110 to be precise. If it was paid to 12,500 salary and the rest as dividends, the total taxes paid would be £31,000, leaving the director with 68,763. So basically, dividends won by £8,653. That was very much the tax efficient way to take the money out. However, then things changed during COVID, and the first change was very much that just kind of after COVID, or after one of the first lockdown or the second lockdown, wherever exactly we were, the government put up both national insurance and dividend tax by 1.25% to help fund the NHS, was kind of the message at the time. But since then, national insurance has come down again, but then down and down and down a few times since, whereas dividend tax rate didn't reduce. So in the current year we're in, to do the same thing with £100,000, you can see there, if you did all a salary, the director would have just over £61,000. The classic split, director gets £63,500. So the gap is still a £2,000 saving in tax. Next week, or the week after the start of the new tax year, dividend tax rates go up again. National insurance stays the same, which means the gap shrinks to £900 on £100,000 being taken out of the business. Now, Clearly, what I'm not saying is £900 is not worth having. If the question is, would you like £900? Would you like to give to HMRC? I'll have the £900. But what it does mean that the margins become quite small, that lots of other things come into account. Because what I'm not saying is that definitively salary is better, dividends are dead, or everyone should change what they're doing. That's not the point. The point is that the old rule of thumb is not as powerful as it used to be. It's not a bad starting point, but we do now need to think, now the gap's narrowed, you need to look at that wider picture around your personal circumstances, your household income, your cash flow, pension planning, future plans, and what the business actually needs. To give you an example of one of those, we did doing some tax plan for a client taking £200,000 from the business, profits about £500,000. In that case, a full salary, I taking the full £200,000 as salary, saved £20,000 in tax compared to the traditional structure. But that was down to her specific circumstances. And a big part of that, nearly half of the saving, was because she had a lot of unused employment allowance, which is where a business can have the first 10,500 of employees NI free, effectively. And because she only had part-time staff, her employers NI bill was not particularly high. And therefore, a good chunk of that was left to be effectively claimed on her salary. So again, the point there, it was very specific, but absolutely, definitely, there became a clear winner when we looked at it. The rule of thumb wasn't right. We also have a number of clients now who prefer to take a full salary because now the gap's narrowed. They'd rather have the salary of a set amount every month, avoiding the hassle of thinking about directors' loan accounts, the hassle of thinking about dividends, a very simple self-assessment, but also the fact just knowing the tax is paid by direct debit by the company every month as PAYE, rather than having to make those two payments every year for self-assessment on top of that. Don't have to think about it. And that's worth, and to use that example, that's worth £900 to take the stress away, the admin away. So the point is, if you are still running on a 10-year-old rule of thumb, small salary, bigger dividends, kind of job done, that's exactly why we kind of need to move the conversation on now and think about the changes, or the fact that salary versus dividends is not the only strategy. It's just one part of a bigger strategy. So extraction versus wealth. And I think this is where a normal accountant and perhaps a profit expert think differently. Because a normal accountant often starts with, how do we take the profit out? But perhaps a better question is, how do we build wealth? Because they're not always the same thing. If it's just about extracting profit, you can end up making some short-term decisions that look tax efficient on paper, but are not actually helping you build anything. So a better conversation might be, what do you need personally, or what do you want personally for the coming year? What does the business need and want? But also, what are you trying to build over the next 2 or 3 years? And therefore, what's the best way of balancing those things? Because I can speak to two business owners with broadly, say, identical profits, but have completely different right answers, because it's what's right for you. One might want more personal income now, the stuff they want to do. One might want to strengthen the balance sheet of the business. One might want to put money into a pension. One might be funding growth of the business. One might be planning for an exit a couple of years down the line. So the answer is not just about this year's tax bill, it is about the bigger plan. And that's what leads to kind of one of the simplest but most useful ways of thinking about kind of owner pay that we called the director pay ladder. And step one is your baseline monthly pay, the boring kind of predictable amount that covers your everyday life, from mortgage to bills to the day-to-day living. And again, that's a different figure for all of us, because our day-to-day living can very much have kind of different amounts. But that thing of what do you need every month to cover what you do. Step two, we planned profit releases, and that can be for the larger things you intend to spend over the next year. And that could be anything, whether it's a holiday, whether it's a new car, it's works to the house, it's school fees paid on a term by term basis. And therefore thinking about how you take the money out at that time. Might be dividends, might be other extraction, but it's done deliberately, not randomly. And then step three is having a rhythm to review that. So as an example, quarterly, we stop and look at your profits. You stop and look at the cash in the business, stop and look at the tax pot, i.e., what you've put aside to pay the taxes, and of course, look at what is coming up next. And I like this because predictable is profitable. What causes stress is often not the tax itself, but it's the uncertainty. It's reacting. It's taking money when it feels available without properly checking the knock-on effects. So I'd much rather see an owner with a sensible baseline, a deliberate kind of review point, and a clear rule for when they can take extra money, come out, because it's calmer, it's more grown up, and it leads to better decisions. There are a number of kind of tripwires as such that make looking at your taxes and simple tax answers much less simple. So someone's why a cheap looking answer can end up being an expensive answer, because once you start layering in things like higher rate bands, when your tax rate goes up from 20 to 40 to 45%, moving in one to another is a tripwire. Just keep an eye on the personal allowance taper. So if you earn between 100 or personally, if you earn between 100 and 125,000 pounds during the year, in that £25,000 margin, as such, for every £2 you earn, you lose £1,000 of tax-free allowance. So therefore, it's a very expensive banding to be in. Child benefit issues. We had a client the other year, husband and wife, making very nice profits of £250,000, but they capped the money they took out at the child benefit limit. It's 60,000 now, it's 50,000 when they were doing it. So they took out £100,000 between them each year for 2 or 3 years, 3 children, about £2,000 a year of child benefits. They didn't want to lose that. But then in year 4, took a lot more out and just didn't get the child benefit that year, and then went back to the £100,000 the year after. Student loans, dividend bands, much like the tax bands, and cash flow timing. So the best answer on paper can kind of shift quite quickly. So it's back to that thing of it's not necessarily salary good and dividends are bad, or dividends good, salary bad. It depends on your plan, and the more your income grows, the more these tripwires matter. So a quick exercise, a quick question to ask yourself. Last year, was your owner pay planned or was it reactive? So in other words, did you sit down and think, this is what I need, this is what the business can afford, and this is how we want to structure it? Or was it more, there seems to be money in the bank, so let's take some out? And the second question is to think about, what's your big goal for the next 12 months? So is it to have more cash in the business? Does it have fewer tax surprises? Is it bigger pension contributions, more predictable drawings, less stress? And think knowing what that goal is helps to put the plan together and what the plan should support. So then we're going to look at some of the, I suppose, tactics, if you want to call them that. And the first one is the missing money problem. So talking about claims and expenses for a moment. For a lot of businesses, overpay tax in very boring ways. It's not because there's some amazing relief they've never heard of or not claiming. I mean, as an example, research and development was lots of people got phone calls off research development experts saying, "Oh, I think you've missed claiming some research and development." Lots of those led to a lot of claims that were not supported, and HMRC have absolutely cracked down upon that. And this isn't about finding some kind of relief. That is something clearly we do with our clients when it is appropriate, and kind of ensure that we claim those. But here it's about the simple ones. It's about expenses getting missed, coding being inconsistent in your bookkeeping, and not having the right evidence to back up claims. And most business owners fall one of two camps. So one of which is underclaiming. So perhaps being overly cautious, disorganized, too busy, or just not knowing about some of the claims they can make. Good example for me here is a client with 2 or 3 weeks ago, turned about £500,000. Lots of perfectly valid business journeys were happening, especially one of the directors driving to customer sites, sales trips, and so on and so forth, but not claiming the mileage. And we do ask them every VAT return, but it wasn't really even properly recorded, so they just were never putting the claim in. And putting that claim in isn't aggressive tax planning. but not putting is leaving money on the table. And we're not about huge sums, but it's stuff they're missing out on. The other camp, of course, of people who overclaim, or at least attempt to put things through that are clearly personal. And this I can tell obviously the Louis Vuitton story. And if you read my email accelerator, whether it was last week or the week before, and to be clear, this webinar is not me just piecing them all together into one webinar. If you read my email accelerator a couple of weeks ago, you know about one of our, we took on a new client as such in the trades who bought a £2,000 tool bag 2 weeks before Christmas. And we're adamant it was Louis Vuitton. Also, we knew it was Louis Vuitton. They're adamant they bought that for its quality and its durability. But just because something is kind of related, is bought in the course of running business, doesn't automatically make it allowable. And if the real purpose is personal, dressing up as business doesn't change the tax treatment. So to use that as an example, there is nothing wrong with spending, if you need a tool bag, you could buy a plastic bag next time you're in the supermarket, or you can spend £2,000 on a tool bag. There is nothing actually wrong with that, but it does need to be holding exclusively for the business. So if you use the tool bag, take the tools out and use it personally, even just once, strictly speaking, it's not a business purchase anymore. And therefore, there's that overclaiming thing of people claiming things, and often, to be honest, just because they don't realise and think in their own mind that it's okay, rather than necessarily trying to do it to kind of get one over on HMRC. But the point is, neither of those camps are ideal. The sensible thing is to be in the middle ground, have a clean system for claiming things, so you claim what you're entitled to. Keep the evidence and keep it consistent. So that way you don't overpay, but you're also not stressing yourself out about what you can do. And really that leads into, to back that up. 3 simple tests for claims. Let's say one is there is a business purpose. As I mentioned a minute ago, the words are wholly and exclusively for the purpose of the business. If there is duality of purpose, generally it will not be eligible for tax relief. Clearly, there are some exceptions, things like mobile phones, you can make personal calls on your laptop, you can browse the internet, but most things, it's either for business or it is not. There's not a middle ground. The second one is having the evidence, so clearly, obviously, the invoices to back that up. And where there is something where it might be thought that is not business, having something set there that if HMRC had to come asking to prove that some thought has gone into this, to back it up, that evidence, then consistency. And generally, if you can't explain the business purpose in a sentence, it's a red flag to HMRC. If you don't have the evidence, it's a red flag. And if you treat the same thing differently from one month to the next, it can be a red flag too. A good simple test is, can you say clearly and calmly, we bought this because it helps us to achieve this. So we bought it for X we bought X because it helps us achieve Y. The question I always ask people sometimes is, would you have bought this if you didn't own the business? And the answer, if you can answer that cleanly and clearly, great. If the answer's a bit wobbly, it probably needs a second look. And the phrase I use, one of my clients gave me this years ago, and she's a salesperson by trade, but I like it, red face syndrome. So if HMRC looked at you and said, was that 100% for business? Would you blush? And it's also been worth kind of knowing that with making tax digital, HMRC are seeing a lot more information. So it's no longer it's just the total on your tax return is going in, or the total on your VAT return. The transactions are part of that, so you can start to look for things that leap out. So to use a couple of examples here of things, clothing is a classic one. So normal everyday clothing is not eligible for tax relief. I rarely wear a suit these days, but there's wears a suit every day. That suit couldn't have tax relief. It's clothing. You need to wear clothing. Even if, my suit was only being used for work, it still has a personal purpose. Now, if it's uniform or if it's genuine protective clothing, that can be different. But even then, the point is it can be different. Not always. We had a HMRC investigation we're going back a few years now, where someone was like picked out the hat to have a look at, and they were relatively new to us actually. And I remember the HMRC inspector sitting there, the HMRC inspector there, client there, and the client saying, like, do you think I've their business meant they were outdoors a lot, and saying, do you think I bought this for fashion? Look at it, waterproofs and what, all this sort of stuff. And they're saying, yeah, but it's clothing, you can't have it. I can see your T-shirt has a big brand across it. You can have that, but you can't have the rest. So that's a classic one. Travel and subsistence, another area people muddle up a bit. Ordinary commuting is not allowable. Genuine business travel usually is, but also meals allowable when they're part of qualifying business travel, but not just because you happen to be hungry while working. And then you get business cars, where the question is not just is the car used for work, but also who owns it, how is it provided, who is using it, what's it being used for. And company cars bring a completely different set of rules. And the kind of Louis Vuitton client actually had all of these. That designer clothing, they were adding the company logo too. But that doesn't immediately make it uniform. It might do if there was more evidence of it. Much of that designer clothing was bought on the same pre-Christmas trip as the bag. Lots of expensive meals in Liverpool being claimed as travel and subsistence. And also, as well as the 2 vans, there were 4 expensive company cars that they said were being purely used for business use. And purely used for business use means never having any personal mileage in it, left at the office overnight, etc., etc. But those 2 vans are for expensive cars with between 3 team members, and that's why they're now an ex-client. So the aim is not to be clever; the aim is to be tidy and to understand the treatment before you assume the answer. So the monthly tax-ready routine. This for me is one of the highest value habits a business owner can have. It's a simple, basic tax-ready routine, not a day out of the office, not 2 hours, 20 minutes a month, past 30, enough to make a real difference, and make sure you upload and file everything. Everything's reconciled. You review your director expenses, including your mileage. Check the tax pot, as in that pot's there to pay a tax bill that will be coming, and flag anything usual. That's it. And kind of 20 minutes a month beats 20 hours next March of looking back. And, it's like everything when it builds up, it becomes harder, and you can't remember what things were, you forget stuff. And it's amazing how much calmer people feel when they know the basic routine to keep things tidy. Because most kind of tax stress is really record stress about keeping records, just wearing a tax hat. So let's move into some of the bigger decisions. First one is pensions. Pensions are not exactly the sexiest topic in business. One of my most overused sayings, and I've used a lot, and we've done a lot of pre-year-end tax meetings over the last few weeks. So I've heard myself say this too many times. There's nothing more boring in business than a pension. There's also nothing more tax efficient in business than a pension. And there's a reason I keep saying that, because for a lot of owner-managed businesses, it is one of the strongest kind of tax saving levers you have. When the company pays into a pension, you can usually reduce the company's corporation tax. You're moving money out of the company very kind of tax efficiently, and you're building your personal wealth at the same time, which is a pretty good combination. Now, the key thing is there are actually 2 separate year ends to think about pensions. Firstly, the 5th of April matters for your personal tax year. As a general rule, each of us has a pension annual allowance of £60,000, i.e. you can put money into a pension of up to £60,000 each year and have tax relief upon that. You can carry forward some from previous years if not used. But if you're looking at your own personal pension planning, therefore the 5th of April every year is a bit of a cut-off, whether it's for this year's or there's a limit of 3 years you can carry stuff forward. It's looking at that. But then the company year end is important too, because if the company wants the deduction in its accounts and therefore the reduction in its corporation tax bill, the payment generally needs to be made in that accounting period, i.e. it's not just been discussed, it's not just been accrued, it has been paid, the cash has moved. So from the company's point of view, the company year end matters more than the 5th of April. To the individual, the 5th of April matters too. As owner managers, both of them matter. So it's both which tax year do you want to count it in personally, and which accounting periods do I want it in for the business. So that's where pensions can be really, really useful. I've got a meeting later this morning with a client who actually is probably doing one of the taking the pensions and upping it a level in tax savings by investing in a SIP, where a SIP type pension where the pension can then invest in, and in this instance, a commercial building, where then the pension owns the commercial building, the rent drops into the pension tax free, and when the building is sold at some point in the future for a profit, that profit is also tax free into the pension. So there's lots of stuff with pensions, and it needs I'm an expert at talking about the tax relief on pensions. I'm not a financial advisor, and therefore can't advise on the precise, legalities of putting it into a pension. That's not my job. That's someone else's. On tax terms, it's great. So the meeting in an hour or two is me, the client, and their independent financial advisor all coming together to make this work. Equipment and vehicles. These sit together quite nicely because the issue's similar. I mean, often you kind of make a decision about buying something. It might be emotionally first, it might be practically first, but think about the tax later because there's something you want or need for the business, and it comes, and you think, well, can I claim it? But actually, it's not just about that. It's about thinking, why you're buying it, what's it do to cash flow, but also the tax impact around the tax year end and the company year end, because that timing matters. Like I say, when I do pre-year end meetings, often there's a discussion about things that you're going to buy. And I always say it's not about buying things for fun to get tax relief. It's what large items might be thinking about buying in the next few months, that buying 1 week before the year end gets the tax relief 1 year earlier than buying a week later. And that could be things like, obviously, if you a business with plant and machine, it would be something as big as that. It might be a laptop, it might be a monitor, it might be a desk, or it might be a car. So let's say your company has a 31st of March year end and buys a new £50,000 electric car on the 31st of March 2026. From the corporation tax side, the company can deduct the full £50,000 gets profits in that accounting period, assume it qualifies for the 100% first year allowance. If the company's paying corporation tax at 25%, that's a potential tax saving of £12,500 in that tax year, i.e. against the payment made on 1st of Jan 2027. But from the personal side, then there is a benefit in kind, but the benefit in kind will only run for the 5 or 6 days through to 5th of April. The benefit in kind on an electric car, I mean, it's 3%. So that's £1,500. Then shrunk down to that week is about 30 quid, and you're taxed upon that. So there is a big net saving there. And it's 1 year earlier than buying the car a week later. And that's the kind of point, is thinking about that kind of timing. It's not just the headline corporation tax, it's the timing of it. Another one of my clients took that to heart last March, and they bought 2 electric cars on the last day of the year, because it's a nice real life example of how they're where they wanted to do it and just moves quite quickly to do it, to get it into the year and bring that tax saving forward a year than if they'd done it a month or so later. Family planning, which I mean in a tax purpose rather than any kind of way here. This is making sure that where family members are generally involved in the business or generally own shares, the structure reflects reality and is documented properly. In practice, there are usually 2 main routes we think about here. First is payroll. So if a family member on the payroll, company gets tax relief, and obviously the family member receives a salary. If they're genuinely doing work for the business, paying them a sensible commercial salary for real work done can be legitimate, and the benefits you may be moving income into the hands of someone with spare allowances or a lower tax band than you, while also getting that corporation tax deduction. Second method is ownership. So if a family member may have shares and generally own shares, dividends can be potentially made to them, and again using up spare tax-free allowances, lower tax rate bands, and so on and so forth, to make the family tax position better. So the reason people look at this is kind of obvious enough, and done properly, it can improve the family tax position. But the important words there are done properly. If the salary isn't for real work, or the shareholding isn't genuine, or the paperwork is weak, it can create problems at HMRC's end, because they can potentially disallow it, and therefore stress and risk. So the message here is it can be a very good tax planning, family planning route, but only if it's real and properly documented, and it supports that wider tax position sensibly. Because it's less about trying to be clever and more about getting the structure right. Benefits and expenses, and we said earlier about claim too little, you overpay, claim too much, you worry, and a clean system wins. But just to touch on a few others, we covered some earlier on clothing, travel assistance, and cars. But what else can you claim? Well, the classic one are perks as such, and these are the trivial benefits exemption. Broadly, if you buy something for a team member or what have you that costs £50 or less, is not cash or a cash voucher, is not a contractual entitlement, and is not reward, just a straight reward for work done, it's exempt from tax. It's kind of a gift as such. That can be a voucher for a shop, just not one they can actually go in and swap it for cash. And it can be used to pay against something. But then it's exempt from tax. So what that means is the company gets tax relief on it, and the employee receives it tax-free. It's kind of done. It was a gift. If you're a director of a business, there is an annual cap of £300. So each individual one can't be more than 50, and you can have up to £300. For employees, there is no actual cap. But it's that thing. It shouldn't be can't be contractual entitlement. So you couldn't, to an extent, replace the whole salary with vouchers because you've got a contract to pay them the salary. It should be for bits on top of that. Staff entertaining, linked to that is a staff event can be exempt. There are rules around that about everyone needs to be invited and so on and so forth. But it's also, there's an annual limit of £150 per head upon that. You can spend that across a few events, but if any one event cost more than £150, that whole event doesn't qualify anymore. So while it does qualify, again, company gets tax relief, individual goes then, has a good time and no tax. If you go over the limit, you can knock out the tax relief and also potentially lead to a tax bill on the employee. You can do other staff benefits too, because to an extent you can buy anything for your team. So if I want to buy one of the team a couch for £1,000 for their living room, I can, but ultimately there's no exemption to tax on that. So it'd be treated as if I'd given them £1,000 of salary. So there'd be employer's NI on that to me at 15%, £150, and I'd have to deduct PAYE NI as if I'd given them £1,000. Or alternatively, put it on a P11D. So that, but ultimately the tax ending is the same, but there'll be tax and national insurance upon it. We have a client who actually does a prize draw every month, and one of the team, the original idea was they want a holiday, and when they first did it, they did actually get vouchers for TUI or somebody, £1,500. But with that, to make it work, we actually put it onto their pay slip. The person who wins it goes to go onto the pay slip, therefore with the correct NI, PAYE, etc. But we work backwards so that there is a net amount of £1,500 either drops into their bank account. I initially did it with vouchers, now we actually do it with cash. But it's not a case of we just give them £1,500 and so on and so forth. No, that £1,500 becomes a gross salary of £2,500. Obviously depend on the individual's tax circumstances. So again, the question is not can the business pay for it, it's what's the tax treatment of when you do pay for it. Now, keeping cash in the business. This is what I think a lot of people don't talk about enough, because sometimes the smartest move isn't taking more out, it's leaving more money in, because we all want to extract profits efficiently, but tax efficient extraction is not clever if it leaves the business tight on cash, unable to invest or hire or cope with a wobble, or constantly firefighting. I'd much rather see a business with a bit more strength and resilience, and one where the owners want a tiny tax battle lost to the wider business more get my words out. Won the tiny tax battle, but lost the wider business war. So this is where planning matters again, not just how do I take it out, but basically, do I want to take it out? What's the business need? And then the owner manager checklist. We've got a download actually with more detail on this, but it's the summary of the whole session. I could have done it in 7 minutes. What do I do now? What do I track monthly? What do I plan early? And what do I need to ask the accountant? That's that, in a way, is the whole thing. So if you took those 4 headings away, that would be useful, because most owner manager tax paying happens on one of those 4, or none of those 4 are happening properly. So this is kind of a 1-page reset, like through some more detail, PDF that you can download and we'll send to you afterwards. And the 5 questions ask your accountant, it's basically, can they talk sensibly about a 12-month director pay plan, what you should be tracking monthly, top on opportunities to plan for, the top risks to avoid, and what should be checked before making a kind of a big move, a big amount out. And if you can do that, great. And like I say, it generally may be that's an additional service to go through in detail, because a bit like with our clients, we have a quick query service which allows a certain amount of time to ask things. But if it becomes a calculation, often say if I have to get your calculator out, there may be a fee. For others, it's kind of included for what they're already paying. Because the 4 common tax traps are the first one is the tax pot isn't funded. So the bill comes along and there isn't enough to pay it because not been budgeting through the year. Second one, the owner pays reactive. Oh, how much is in the bank? Oh, I'll have that. Third one is decisions made without advice. I speak in somebody before doing it. And the fourth one is kind of the evidence is messy to back things up. And the truth is, people don't get into trouble because they do anything outrageous. They usually get into trouble because they're busy. They're running a business, juggling 10 things. Finance side gets done in a rush. So the fix here isn't some kind of big superhero kind of fix. It is a boring discipline, the accountant's strength, because boring discipline saves a surprising amount of money. And what we're looking to do is go from a before situation of surprises, stress, and messy habits to an after, having that pay ladder, the monthly routine, the cleaner system. And it doesn't just change the tax, it changes the feeling. Your surprises reduce, conversations get calmer, the owner feels back in control, and that kind of really matters. And how that fits in, we launched that 6 months ago now, a profits pathway for most for most new clients. And what it was doing is really take lots of stuff we do and just like put them into one thing. And to show you on the screen, that's our profits pathway. And most of the text bit sits in resilience, because it's what our tax diagnostic is for. It sits in a pathway, because this sort of planning shouldn't be a once-a-year panic move kind of in March. It becomes part of the normal rhythm. So remuneration planning, tax planning, cash flow, profit, business decisions, they do all affect each other. And if you treat them as little isolated topics, you often end up making weaker decisions. Whereas if they're all inside a proper process, the quality of decision-making improves. So that's how it fits into our wider journey. And if someone's on the pathway, we kind of do all this with them. But as a one-off next step, what we do is a tax diagnostic. It does sit in that pathway, but this is one thing where we do a one-off review. If it's something you're interested in, actually, anyone who's on this call today is welcome to book one of these. There's a report at the end of it. No need to change accountants, but we look at your missed opportunities. It's like I call it no stone unturned checklist. It's a bit of a decision tree where we ask you questions and go through and just work out, check you're not missing anything. This kind of thing does flag up some biggies. This has flagged up in the past R&D and theatre tax credits and the likes. But often, sometimes it is a nice, almost just a telling you, great, you've done it right. And I'll put on the screen now the QR code for that if you'd like to do it. I'll leave the QR code on the screen, and we will send out an email if that's something you'd like to book. It takes about 45 minutes for us to effectively go through the questionnaire together, and then we deliver a report to you after that. So on that, I'm conscious, because we started a little late due to the technical issues, we're just going into Q&A. But what I'll probably do is therefore for anyone who does need to leave as we hit the end of the session, right now, having started a bit early, that's kind of fine. And I won't probably do the Q&A. It's actually got give me. I'm going to do one question, which is I'm undecided on whether to make a large pension contribution or to keep the money in the business in order to show the higher profits. We'll be approaching lenders to funding on business acquisitions later this year. Okay, so yeah, because clearly, if you're looking for lending, if you're looking to exit, people look at your profits. Now, ordinarily, when doing that, they will look at the fuller picture. And as an example, of course, if your profits, if you've taken a big director's salary, are much lower than if you did it as dividends. But when speaking to a lender, a purchaser, they would generally take that out, whichever way you extracted the profits, and that would include a pension. So the pension itself shouldn't be a barrier to lending because they are wise enough to understand that. And really, because any lender you're discussing with, there should be a discussion and a story. So I hope that helps on that one. So on that, I'm going to say we are obviously next time we're doing our next profit event. A month from now, it'll be on your growth engine to pick your best 2 channels. If you'd like to book a tax diagnostic, that'd be absolutely great. To be very happy to see you and get that booked in. You can either use the QR code or, like I say, we'll be sending out an email after this event with a link to do that as well. So on that, thank you very much for coming on. I apologise for the slight late start, but hopefully I've got you away 1 minute after schedule, and I very much hope to see you next time. Thank you.